What's up, everyone? It's Candy with MoneyVest. So markets continue to trade close to all-time highs. We are less than 1% away from all-time highs for both the S&P 500 and the NASDAQ. So this is going to be a little bit of an update on where we are as volatility continues to come down to pretty extreme levels on the lower end of the spectrum, as we are seeing the volatility now back in the 12s. After, of course, getting up to as much as over 21. And there's also a report that I want to break down in this video, which essentially suggests that there is a possibility that we're only going to see a 1% rate of return from the S&P 500 over the next decade, so over the next 10 years. So lots to unpack. We've, of course, got a lot of earnings to also break down, and I will be doing separate, more dedicated videos on those companies as well. As always, if you enjoyed this video and find it helpful, I would really appreciate that if you, of course, drop a like and subscribe to the channel. And of course, do join our Discord and Patreon down below. We've got a little bit over 800, 900 members that are part of the community that are, of course, globally here, able to engage and, of course, communicate with each other, share best practices, learn lessons, and, of course, understand how to analyze the markets from a more risk-reward standpoint and get access to all the other benefits, including our private videos, alerts channels, as well as our trading view charts and access to the beta launch for the MoneyVest website as well. So link's going to be down below. We'd love to have you on board. So first things first, let's quickly break down, the market's recovery here. So this is the S&P 500 and how well it has, of course, moved back higher. A little bit of a V-shaped recovery, as of course the volatility has an A-shaped reversal, as it's obviously inversely correlated for the most part. As VIX comes down, volatility moves back higher, and now we are in the 12.55 level. If you come over to the S&P 500 here, we're at 52.22, so almost near all-time highs, and the volatility 12.56 to be precise, which is once again a rare occurrence in the market. We are in the 14 percentile, because if you come down here, 25 percentile is a 13.91. So we are at an extreme low level here on the volatility. So there is a possibility for a VIX spike once again. So, it wouldn't be the best. It wouldn't be the worst idea to get some VIX calls or to hedge on that potential downside if you do get that volatility spike here, because put prices are going to be lower. Premiums for puts are going to be cheaper right now. That's going to act as a potential hedge. And of course, premiums for VIX calls are also going to be cheap. So both on the put side, buying puts and buying calls are going to actually be cheaper trades as a potential hedge if you are interested in that type of course, in that type of trading style. But for me personally, that's a good thing, because it kind of helps me understand, okay, markets are approaching back up to all-time highs here. Volatility is really low. It's again, our VIX rareometer is suggesting for a rare occurrence in the 14 percentile, which again is really, really low. It's kind of red right now, 12.55. The more it gets down further, the more red it's going to be. And of course, we're going to be down to like 10 and 5 and 4 percentiles, which is going to be extremely rare from a volatility standpoint, because if you come take a look over here, days spent under 10 in the last 35, 37 years is only 68, right? So that is less than 1% for the volatility in terms of days spent under 10, and right now we're at 12.5. So, another 20% decline here in volatility, and it's going to be now even more rare than where it already is. So that's something to keep in mind, because, again, obviously volatility, if it does end up, let's say, spiking back higher from these levels, back up to, let's say, 15, 16, then obviously that's going to result in the markets rolling over a little bit back down. Now, moving forward, by the end of March, valuations had gotten very steep. So this was a little over 21 times earnings multiple on the S&P 500. And that's why we saw a little bit of a decline from the markets, and now we're recovering back up here. This was also very interesting from bar chart that suggests that 0 DTE, so 0 days to expiration options on the S&P 500 now account for almost 50% of all options volume on the S&P 500. So you got a lot of gamblers in the house here, as they are betting on 0 DT options that can be extremely volatile, because the expiration is quite literally in hours and not even days. And so those options are vulnerable to a lot of volatility. This right here is again individual sectors. This was posted by Mike Zaccardi. Shout out to him on Twitter, posting for the entire valuation assessment on the S&P 500, including all the individual sectors. So again, next 12-month price earnings multiple for the S&P a little bit over 20, and the PEG ratio is 1.3. And then if you compare that to some of the other sectors like consumer staples, for example, 2.5, utilities trading at 2.3, energy also a little bit of an expensive sector at 2.9 PEG ratio, even though their price to earnings multiple on the next 12-month basis may seem low at 17, 20 times or even 12 and a half, but relative to their growth, they're certainly trading at more expensive numbers here. Financials, as I've already pointed out, is one of these sectors that I think has a lot of value. 1.4 times PEG ratio, 15 times earnings multiple, so continues to trade at very attractive valuations here. And then, of course, if you compare that to information technology, which is tech in general, trading at over 1.5 PEG ratio and a 27 times earnings multiple, which is one of the highest, in fact, the highest multiple that we have here. Consumer discretionary is going to be 24. That's your Amazons and Teslas. 1.3 PEG ratio, still quite reasonable. And then one of the best sectors, in my opinion, right now still stands communication services. Comm services, exactly 1 PEG ratio, which is actually cheaper than the entire market, and 18.5 times earnings multiple, also lower than the entire market. So something to keep in mind. Financials and comm services, in my opinion, two very, very good sectors to be looking at for value. Now, this right here is earnings expectations from the S&P 500. So next 12-month forward EPS, when you exclude for the NASDAQ 100 companies, right? Those are your big tech, including big tech, of course, making majority of the market here. When you exclude for those companies, earnings expectations are pretty flat. They're not expected to go anywhere, basically flat on a year-over-year basis. So that is something to keep in mind because, of course, we are going to of course account for the Magnificent Seven companies because they make up over 30%, 35% of the NASDAQ 100 and over 25% of the S&P 500. But the rest of the market isn't really growing all that much from an earnings standpoint. Now, this right here is something that I wanted to break down, which is actually quite interesting, and that is to say how the S&P 500's return over the next decade, over the next 10 years, could average just 1% per year. So that is a pretty bold claim. 1% is very, very dry returns compared to what we have already seen. So corporate American profits can't keep growing forever. And that's really the thesis that they're coming up with, is that margins can't keep going up forever, right? Margins meaning profit margins for S&P 500 companies. So S&P 500, S&P Dow Jones Indices estimates that based on results from the nearly complete first quarter earnings season, the S&P's operating profit margin in the first quarter was 11.76%, which is actually a little bit higher than the trailing 4 quarters at 11.4% and significantly higher than its long-term average of about 8%. So this right here is the trend line, which essentially suggests the profit margins of S&P 500 companies. And of course, we did have that spike during COVID. Now margins have come down to a more stable level, somewhere between 10 and 12%. And the red dotted line is the mean, is the basic trend line as which we're seeing that linear growth. But how long is that going to go on for? That's the real question, because if the S&P 500 profit margins continue to follow the trend line for calendar 2024, it will be above 12%, well above the 30-year average of about 8%, which is very good, right? 12% is fantastic profit margins for S&P 500 companies. And that's precisely what analysts are estimating. But few are aware of how much the stock market's current lofty level is dependent on profit margin expanding. So what happens is, and this is where this spreadsheet comes in. So what you'll notice is the fact that, and the reason why the S&P 500 has done so well over the years is because earnings have grown very nicely, right? So if you take a look at the overall long term since 1960s, right? This is a chart, this is an Excel spreadsheet that I've put together. And this is the P multiple for the S&P. This is the actual value of the S&P 500. And this is the earnings per share for S&P 500. And since 1960s, you'll notice that we have gone from $3.10 to now $220 as of last year. And that's a compounded annual growth rate in the last 60 years, 63, 64 years of over 7%, right? That's the compounded annual growth rate as to at what rate have earnings grown in the S&P 500 over the last 60 years for the companies that are part of the index at 7%. And guess the return of the S&P 500, the price return of S&P 500 has been just over 7%. So both of these numbers are actually quite, over a long-term basis, correlated with each other. right? Some years S&P 500 earnings grow at 12%, 18%. S&P 500 in itself returns as 4%, 6%. Some years S&P 500 return will be higher, earnings growth will be lower. Some years it'll be more or less. So of course, it's not perfect each time. It's not like the earnings are growing at 10% and the markets are returning 10%. No. Some years, obviously, it's going to fluctuate. Every year, it's going to fluctuate. It's going to be more or less different. But over long periods of time, if you look at over the last 60 plus years, they have been very close to each other, right? Just over 7%. And that's why that's the average rate of return, because earnings are growing at 7%. Now, this 7% that you see is a product of two things, right? It's a product of two things. Number one, revenue growth. And number two, margin expansion, right? Number one, meaning revenue growth, right? So S&P 500 companies, the 500 companies that are part of the index, the constituents, have grown their revenues over the last 60 plus years, right? They've gone from, whatever hundreds of billions of dollars they were doing to now well over trillions of dollars in revenue. And margins have also gone up. Margins have expanded, right? From a 30-year average of 8% to now 12%. So that, again, is a very fantastic growth in margins. But the idea here is how high can these margins keep going, right? So if the latest quarter profit margins were the same as it was 30 years ago, so if the latest quarter profit margins were the same as 30 years ago at 8%, holding everything else constant, the S&P today would be trading at 23.95. But because we've seen so much expansion in margins, markets are trading at well over 5,000. Economists have long wondered how much longer the profit margins can continue rising. Much of the increase over the decades have come at the expense of labor, whose share of gross domestic income has fallen over the last 30 years to 43% from 46%, and this distinct 3-decade downtrend is clearly evident from the chart below. So, of course, wages have not grown at the same rate as margins have expanded and prices have gone up. So the cost of labor or cost of production has of course, as a percentage of the overall revenue and not to mention GDP, has been continuing to go down. This right here is a perfect chart that illustrates that. So as a result, margins have continued to expand. But how long is that going to continue? Because, if you essentially look at without increasing profit margins, future stock market returns can only come from two sources. Okay. And that is corporate sales growth, which is the revenue growth that we talked about. So basically, if let's say S&P 500 continues to maintain a 12% profit margin, then they really need to keep growing the revenue in order to generate more earnings, right? I hope that makes sense. Because the accelerated earnings comes from both revenue growth and margin expansion. If both things are firing off, then yes, the earnings growth is going to be much, much better. But if earnings growth, if margin expansion doesn't happen, then earnings growth is going to be solely dependent on revenue growth. Okay, that's the denominator piece of the equation, which is the actual earnings. Now, when you come over to the S&P 500, for us to see higher rate of returns, what else needs to happen? There needs to be higher levels of multiples, right? Earnings multiples. So this right here is the third column that we didn't go over. On average, you'll notice it's been trading around 16 to 17.5 price to earnings multiple. This is on average. This is on a median basis over the last 60 plus years. And of course, right now we're well over 21.5, close to those levels on a trailing basis. So in order for the S&P 500 to continue to perform well, three things need to happen simultaneously as they have happened in the past. Number one, revenue needs to keep growing, right? For all the companies in the S&P 500, revenue sales, corporate sales need to continue to go up. Number two, profit margins need to continue to expand. Even if they don't go up, they need to maintain and at a stable level, right? They can't come down. They can compress. That's number two. Number three, multiples need to also expand and of course at least stay stable, right? Around 20 to 21, 22 times earnings multiple. Of course, the higher these numbers go. So if we have revenue growth, margin expansion, and multiple expansion, all three things at the same time, that's a recipe for the best market environment, for markets to do really well and for the returns to be very positive. If two out of those three things don't happen, if margins don't expand and multiples don't expand, that's when this article comes into the equation. That's when they're actually suggesting for 1% on average because they're only accounting for revenue growth. That's it. If margins stay where they are, multiples stay where they are, and revenues only go up by 2 to 3% every year, because of course as numbers get bigger and bigger, the growth rates are going to come down, obviously. So then of course we're only looking at 1% per year. So really what they're banking on is economies of scale, right? Economies of scale meaning cost of production, cost of labor, operating expenses coming down, and for companies to be able to achieve higher margins of profit. And higher margins of profit is going to potentially lead to higher multiples, which is going to lead to higher rate of return. And that's what we have witnessed over the last, several decades. So that's really what it comes down to. And I want to hear from all of you. I really would like to engage into this discussion with all of you. Comment down below. What do you think from the S&P 500 over the next decade with this discussion around earnings growth, multiples, and margins? I would love to know from you guys as well. So comment down below if you have any analysis or perspectives to share. Now, overall, the markets, on Friday were up, so that was good. So Broadcom, Nvidia, Micron, so semiconductors pushing higher. Some of the big tech, Apple, Google, Amazon, Tesla, selling off a little bit. So this right here was the entire market. So a little bit of a pullback in communication services and consumer cyclicals, and Apple also selling off. So a bit of a split market on the day on Friday. In the last 1 week, of course, most sectors are green. And in the last 1 week, utilities are the ones that are crushing it absolutely, along with consumer defensives pushing higher. Soybean, orange juice, wheat, all pushing higher with cotton. We got volatility. We got sugar prices, heating oil, natural gas selling off. And Bitcoin just over 61,000 and Ether just under $3,000 as well. So coming over to the markets, again, we've already gone over volatility. Keep a close eye. It is rare in the 14th percentile, so there is an opportunity for the VIX to spike here, consistently selling off. So just got to be super careful with the markets here at these levels as they are approaching a resistance, pretty much the all-time high, not to mention inflation numbers coming out next week as well. Talking about the 10-year treasuries, they are pushing back up. So we're now 4.5% steady, up almost 1% on Friday. Of course, a very critical level at 4.7.5. And again, massive area of previous resistance and support here in the 4.2.5% for the 10-year treasuries as well. Going over to crude oil, we continue to slide lower, which is a good thing. It's going to help inflation eventually. We got a breakdown from this head and shoulders. Neckline was around that $80 per barrel level. And of course, we broke down, and the next target is going to be closer to 73 to as much as $74 a barrel for crude oil. Coming over to the market, so S&P 500 continues to really just consolidate sideways. So we're going to go ahead and turn this level into a support, as it did manage to close above 52.20. So this is going to be a support, basically a flat day for the S&P, and the next target pretty much is going to be the all-time high at 52.60 inside this red rectangle. It's going to really be interesting next week with inflation, whether we get a breakout above this level, whether we get a retest of those levels or not. Talking about NASDAQ, and again, we're practically at all-time highs, but we do have a quadruple resistance on the 30-minute time frame that we need to watch very carefully, and that's going to be sitting roughly at 16,470. That's going to be this level right here. And for the most part, we've just been consolidating sideways with a massive support at 16K down to as low as 15,900 on the NASDAQ as well. Now, going over to individual stocks. So Apple here, pushing higher. Last week was, in fact, very strong, 8% green after the earnings. And of course, this week was reasonable, basically flat. And the target remains roughly at $196 to as much as $200, with a massive support here in the 170s for Apple, all the way down to as low as 150s for this company as well. So, we got to keep a close eye on where Apple ends up trading. I've learned that, the Vision Pro is not doing super well. And I think they're going to have to pivot some of their strategy to kind of understand, okay, they should have had some oversight that not a lot of people are going to pay $4,000 for a product that is, still not fully developed. So for that reason, I think that's a bit of a negative catalyst here for the company because of the lack of innovation that we've already talked about. And a lot of the financial engineering that's happening is on the back of share buybacks. Warren Buffett's been dumping Apple shares as well, as we discussed in our previous video. So keep a close eye at this tier 1 support at 170. I would be a lot more interested, as you already know, in the 150s, down in the 120s for Apple. Amazon hitting new all-time highs, so $4,000 is achievable. We hit a new all-time high at 191, so congrats to all Amazon shareholders. Still at a resistance here at 188, so that is going to be a level to keep in mind as a resistance. Support level is going to stay put down to 170 for Amazon, down to as low as 158 to as low as $143 for Amazon as well. Talking about Tesla, and Tesla here continues to sell off. This past week was down over 7%, getting rejected here once again inside this red rectangle. And you guys already know my strategy with Tesla, and the fact that the moment it gets up to over $200, I'll be looking at selling calls on the company. So that's pretty easy money because every time it gets up to over $200, premiums are very good because people tend to become very optimistic and very bullish on the stock. And then as a result, if you sell calls and of course if it gets rejected, that's very quick, very nice, easy money on Tesla options because of how much volatility there is and how premiums are priced for Tesla options. So keep a close eye here inside this green rectangle. That's going to be the first tier support in the 140s, 150s for Tesla, and of course resistance all the way up to as much as $200 per share. To as much as, of course, 288, but we've got a long way to go until getting up to that point. Support level 1450 down to as low as 127 for Tesla as well. Now, talking a little bit about PayPal, and PayPal continues to struggle down about 2%, so back under $63. And this right here is going to be that uptrend of higher highs and higher lows. So inside this green rectangle, and that's going to be, again, an area of support demand for PayPal that we have continued to validate for this company. I do think the bottom's in, but you just never know with this stock. It's very uncertain. So I'll keep a close eye down here at $57, down to as low as $50 for PayPal. I mean, it's possible that it gets down to that level, but so the thing with PayPal here, what I'm trying to really accomplish, since I am down on the position, is I'm planning on buying a lot of shares. Like I'm planning on dollar cost averaging really, really aggressively, like very heavily, and I'm talking like I'm planning on buying like 1,100, 1,500 shares to really bring my cost basis down in the 70s, and then immediately sell calls. Sell calls on the next potential spike up to $68, $70 per share. That's one of the ways to de-risk and get rid of some of the position. But I haven't finalized on that yet. It really does require very, very precise understanding of timing the trade and of course being okay with having a losing position being the biggest position of your portfolio for a short period of time until you execute this. That's one of the ways you can actually get out of a losing position, but I don't recommend it to anybody. I don't recommend it to myself either. And the reason being is because it can be very, very risky because you're essentially doubling down on a losing position in a massive way because you're dollar cost averaging into that stock. So that's something that I'm going to be thinking about because they do have a few more events coming up. PayPal has, so we'll talk about that, and of course we'll discuss that in our Discord. I'll share more details for that in our Discord. But support level is going to stay put down at $57 for PayPal. Visa, on the other hand, continues to move higher, so up 79 basis points, a very nice recovery from that support around 265. RSI, MACD, L3 banker oscillator, everything moving in the right direction, looking pretty solid. And resistance is going to be all the way up to 290 for Visa moving forward. So that is going to be that resistance to keep in mind for the company. Now moving over to Nvidia. Nvidia is going to be reporting earnings next week as well. Actually, not next week, the week after. So May 22nd is when they are reporting. So I think all eyes and ears are going to be in the month of May, for rest of May, is going to be on Nvidia and how they perform pre-earnings and post-earnings. But resistance is going to stay put at $900. I was actually thinking about doing a buy right on Nvidia, buying 100 shares at these prices and immediately selling a call, which is close to the money, $5 or $10 out, because the premiums are insane. I mean, you're getting $50, $60 a contract. If you take a look at the premiums right now, if I pull them up, let's just quickly go over to Nvidia, because the last time I checked, the premiums were quite literally insane for 30 days out. So if you go to, let's say, 34 days, June 14th, let me see, we'll just do 30. Okay, so 898. If we go to calls out as much as, let's say, 905, the bid is going to be at around $60, right? That's crazy. That's over $6,000 for one contract. But then of course you're buying, a $90,000 position. So if you do the math here, 60 divided by 900, that is about 6.6% return on collateral. Based on your cost basis, that's a 6.6% return over the next 30 days. So Nvidia premiums for puts and calls is quite literally insane. I mean, people who have Nvidia shares and who have a lot of Nvidia shares, I mean, you guys better be selling calls. I'm not even kidding. I don't care how far out you have to go or how far out of the money you have to go. You better be taking advantage of this. I mean, just think about this. Even a $1,000 call on Nvidia is giving you $2,800 per contract. I'm telling you, if you are watching this video and you are an Nvidia shareholder of over 100 shares, you better be taking advantage of this. Because if you go, let's just forget about that. Go over to $1,200. It's way out of the money. Delta is so low. Like if you come take a look at the delta here, we're looking at 0.07. The probability of Nvidia getting to $1,200 by June 14th is really low. And you're getting free money, $470, right? $470 in 1 month. Take it. Take it. In my opinion, take it. You can go even as far as like $1,400, folks. That's still $118. So my point is that if you have Nvidia shares, premiums are juicy. AF. Take advantage while it's like this. So resistance is going to stay put at $909. Support level is going to stay put at $842. Talking about advanced micro devices now, AMD continues to kind of trade inside this downtrending channel of lower highs and lower lows, of course. Resistance is going to stay put at 164 and support level here inside this green rectangle. And again, this is the downtrending channel. If it ends up, let's say, breaking down below this 145, 140 level, the next support is going to be down at 130. Now, the difference is that AMD doesn't have very good premiums for puts, even though it's been selling off. So if you come over to the puts here for advanced micro devices, and let's just go to the same expiration, June 14th, and we're looking at puts here. So if I come down to, let's say, 130, I'm only getting 77 cents, right? That's really, really low. That's practically nothing, even though it's got a really low delta, and that's what I like to see, under 0.2. But 77 cents, this really isn't compensating for anything. Yes, it's something, $77, but you're putting up 13 grand and getting $77 in return. That's nothing. So I'm waiting for the premiums to kind of go up and be a little bit better in terms of AMD puts here, but you just got to wait. You just got to wait for it to come down to 140s and then look at 130 puts or down at 120 puts the moment it gets down to 130. So yeah, for AMD, I think it's going to be a little bit more patience here because I do want to own this more of AMD stock over the long term, but patience is needed. Talking about Meta platforms now, and Meta here continues to kind of now trade at this resistance inside this area of supply. So we're just waiting to see whether it breaks out or not. Looks pretty strong to me, so there is possibility for a breakout beyond 477, 478. And the next target's going to be all the way up to 525. It's going to really just put us back into this area of resistance. And you know what? If I do a buy right on Meta, let's just quickly check Meta calls. So what are the premiums like for 34 days out, June 14th? For Meta calls, let's say 480, we got $14, $10 here for 490. Actually, this might not be a bad trade. $10 at 476. Cost base is going to come down to 466. But yeah, that's 466 is like, yeah, only 2% away from where it is. So in the next like month, Meta could easily drop more than 2%, and thereby, yes, the call is going to be out of the money. It's going to be profitable, but the underlying position is going to be in an unrealized loss. So don't want that. But for Nvidia, there's actually very high margin of safety because a buy right, $60 is going to be about almost a 7% decline. We're just going to be down to 840. So I'll see if I can target this number down to $800. We'll have to run that math here because $800 is actually going to be a 10% decline. Or a little bit more than 10%, 11% decline. And that is possible on earnings, by the way, on May 22nd. So we'll keep a close eye on that. Netflix, on the other hand, starting to pull back. Support level is going to stay down to 597. Resistance and targets are still at 636. Very nice recovery back up. So we'll keep a close eye on this stock here. Support level, like I said, at 597 here. Google, on the other hand, just consolidating sideways. So it did get bought up here intraday, but I would say like it's still in a little bit of a no man's land, where after the earnings gapped up, pulled back, and it's right now pushing back higher. And of course, area of support and demand is going to stay in the 150s for Google with these higher highs and higher lows for Google. Microsoft, on the other hand, also pushing higher. Resistance is going to stay put at 417 for Microsoft, and support level is going to stay put at 393, close to $400 for the company, and all the way up to as much as 430. And then finally we come over to Enphase and Costco. Enphase still very much in the context of a little bit of a downtrend, so lower highs and lower lows. Massive support here in the $106, $107 per share range, and resistance and targets back up to 137. We got a double top resistance here, so Enphase really needs to break out above those levels. And finally we come over to Costco. Costco's been very strong recently, hitting a new all-time high at 787. So massive move to the upside, now approaching a, well, I guess it's starting to break out, so new all-time highs. So congratulations here. Valuations high, you know, MACD, RSI, and the L3 Banker Oscillator, everything is now overbought. So I'd be super careful with Costco at these levels. So, hope you all enjoyed this video and found it helpful. A complete update on the markets. Make sure you drop a like and subscribe to the channel. I would really appreciate that. Links to our Discord and Patreon is going to be down below if you want to join. Of course, be a part of our MoneyVest community. And if you have any questions, I'm more than happy to help and answer. As always, happy investing. I'll see you all in the next video.